Hello and welcome to your December Investor Update. I'm James McManus, Chief Investment Officer at Nutmeg. In this update, I'll cover market performance in November, how global financial markets reacted to the November US election, and the outlook for emerging markets. What happened in financial markets in November, and can you explain the main drivers? Global equity markets finished November in positive territory with gains led by US equities, which produced one of their strongest months of 2024. Shares in large US companies, also called large cap equities, rose 5.9% in dollar terms, while smaller companies, or small caps, had a particularly strong month, rising 10.2%. The driver? A Republican clean sweep in the US election, offering investors optimism over the potential for future US economic growth, coupled with tax breaks and deregulation under the new administration. In the rest of the world, Japanese and UK stock markets delivered more muted returns in November. Japanese stocks fell 0.8% and the UK FTSE 100 gained 2.6% in local currency terms. European markets, meanwhile, declined as investors digested the potential ramifications of the incoming Republican administration, specifically talk of trade tariffs against a backdrop of already weak industrial activity. Emerging markets also delivered negative returns, falling 3.5% in November. China was amongst the largest losers, but most major emerging markets stock markets ended the month in negative territory. The exception was India, where stock markets rose slightly in November and where domestic economic activity indicators remained strong. In bond markets, corporate bonds largely mirrored the atmosphere of equity markets, with investors apparently happy to take on more risk. This was reflected in the performance of riskier high-yield bonds, which delivered returns of 1.1%, and UK corporate bonds, which also finished the month having made gains. Government bonds started the month on a weaker footing. Election and inflation uncertainty dominated headlines. However, developed market government bonds finished November with returns of around 1.7% in the UK and 1% in the US. With Donald Trump re-elected in November's US election, what are the implications for investors? Well, it was clear from the market reaction that the re-election of Donald Trump is expected to create distinct winners and losers, yet the president himself is only part of the story. Crucially, the election result has offered Republicans control of not just the White House, but also the Senate and the House of Representatives. And that should make it much easier for the new administration to enact policy. This clean sweep was a possibility, but far from a certainty, and it heightened the market reaction to the election news. Stocks and sectors perceived to benefit from potential policy moves rallied, such as energy and banks, and investors shifted funds to US-denominated assets at the expense of global peers. Meanwhile, assets that are sensitive to trade and tariffs, such as European and emerging stock markets, fell, whilst their currencies also weakened against the US dollar, as investors priced the potential for meaningful tariffs. In Europe, the unstable political picture in France and Germany only added to the reasons for investors to seek US assets. Now, away from stock markets, expectations of looser fiscal policy, that's the way in which the government spends and raises money, including the potential to extend tax breaks brought in during Trump's previous presidency, should provide room for continued US economic growth. That has, however, kept bond market investors wary, as concerns grow over the extent of the administration's plans to increase borrowing and the potential for future tariff-related inflation pressures. Consequently, the number of expected rate cuts from the Federal Reserve over the coming 18 months has fallen post-election. Now, we anticipate over the medium to long term, the US will continue to benefit from a resurgence in domestic investment at the expense of the rest of the world, notably emerging markets. That was also our expectation for the outgoing US administration, but we believe this dynamic may unfold in a less smooth and predictable manner going forward. Trade tariffs are front of mind again as investors look ahead to 2025. How does this affect Nutmeg's outlook for emerging markets and global trade? The Nutmeg investment team currently holds a smaller allocation to China than our long-term benchmark, given the challenges we feel the Chinese economy faces from both an internal consumption and external trade perspective. But for much of 2024, we've held a much more positive view on the outlook for wider emerging markets, given what looked like an ongoing recovery in global trade volumes and demand for durable goods alongside cheaper market valuations. That optimism, however, has dimmed somewhat over the last quarter. The early stage recovery and growth signals that we saw in many emerging market economies at the turn of 2024 are now showing signs of slowing. And at the same time, broader emerging markets are facing a number of threats to their outlooks from both an economic and a market perspective. The twin effects of a stronger US dollar, alongside the potential for meaningful trade tariffs, are reducing our confidence in the extent to which global trade can recover from its post-COVID lull. Now, India is a notable bright spot in terms of domestic growth, but valuations look stretched there after a long run of outperformance according to our analysis. Now, the situation is far from desperate, but with manufacturing sectors across developed market economies in contraction and the possibility of tariffs imposed by the global economy's largest importer of goods, the investment case is likely to weaken. Clearly, China, where we have a small allocation, will feel the brunt of those policies. But many other emerging markets, particularly Mexico and those in Southeast Asia with strong trade ties to China, are also unlikely to escape unscathed. They simply face a more uncertain economic and market outlook post the US election. Thanks for watching. If you have any questions or suggestions for a topic you'd like us to discuss in next month's Investor Update, you can contact us via social media, email, or in the comments section below this video.
As with all investing, your capital is at risk. The value of your portfolio with Nutmeg can go down as well as up, and you may get back less than you invest. Past performance and forecasts are not a reliable indicator of future performance. We do not provide investment advice in this update. Always do your own research.